Perfect.
on
Yep.
it. All right, perfect. All right. So, welcome back to Millennial and Boomer Money Concepts. I'm Dan the Millennial with my dad, Steve the Boomer. And today we actually have our very first guest, Dad.
Great.
Very first guest, Val Zarn from Zarn Group Financial Services. And Val is an advanced market specialist with Symmetry Financial Group. Over 20 years experience, and what we're going to be doing is diving into advanced solutions for families, retirements, and overall financial protection. And it's going to be awesome to have you guys have a conversation about it. Val, thanks for joining us.
You bet, Dan. And thank you so much. I appreciate you and the opportunity to share a little bit today with your audience.
Absolutely. And first, Val, so that way our audience can, get some background. What is an advanced market specialist? Like, what do you do as an advanced market specialist?
Yeah, absolutely. And just a little bit about my background. As you mentioned, I've been doing this for quite some time. I started very, very, very young. Just kidding. But I have been doing this for some time. I've been a licensed agent since about 2004 and really put a primary focus on what we refer to as advanced markets, such as indexed universal life and retirement protection. Been doing that since about 2007. So one of my primary functions as an advanced market specialist is education. When I meet with clients, something that I really hear all of the time is, this sounds too good to be true. Or, why isn't everybody doing this? And really the answer is simple. Most people, Dan, are just not aware that these products and solutions even exist.
Yeah, before I met you, I didn't know they existed. Dad probably did. And I know you mentioned a couple of things, and we'll dive into those products. But overall, if you were to boil it down, what kinds of problems are families usually coming to you for help with?
Well, first off, the most common scenario is when a client is coming to me from like an existing client, or maybe someone that I know, right, that knows what I do. Yeah. They've heard about something called an IUL, or maybe heard this little catchphrase, tax-free retirement account. Maybe they heard that somewhere, or maybe they just lost money in the market at some point. Really, my primary function, again, is to help clients, identify if there is even a problem, right?
Yeah.
And to offer, possible solutions.
Awesome. And my brother Tim, the feedback he gave, because we just, the previous episode was on ETFs, and he's like, you need to actually explain what ETF stands for on it, which
Right.
which was our bad. So the IUL, that we've mentioned that a couple of times, and I also heard about it. For someone new, like my brother Tim, who we won't name, just kidding. How do you explain, first part, how do you explain what an IUL is?
Well, an IUL is an alternative vehicle to save towards retirement. Think of 401k, Roth IRA, think of a retirement vehicle. Now, one of the biggest advantages to an IUL over a traditional retirement account like 401k, 403b, and all those other ones that are available is its tax favored status. Okay. So it's a retirement vehicle that has tax favored status. So I got a question for you, Dan.
Yeah.
What do you think? Is it better to pay a lot or little in taxes? What do you think?
Depends, I would say. Well, because I know your tax rate, I think your tax rate is lower the younger you are. So it's better to pay taxes then versus later on it. That would be my guess.
Well, just, and it's not a trick question at all. Like, well, would you rather pay a little or a lot?
Oh, would I rather pay a little? Let's see.
Yeah.
The government may be listening, so I'd rather pay. No, just kidding. I would rather pay
Yeah.
as least amount of taxes as possible. Legally.
Absolutely, right? Absolutely, or absolutely. So here's one of the challenges that I kind of identify. One of those problems those unknown problems, right? So most people don't realize, Dan, Steve, that they have a silent partner in their traditional retirement account, and that silent partner's name is Uncle Sam. Okay. So one of the really common misconceptions is that when you contribute to a traditional retirement account, again, like a 401k, 403b, again, a misconception is that you're actually saving money on taxes, right? You aren't. You're not saving any money on taxes. You're simply deferring them. So it's a tax deferred vehicle. Those sort of vehicles are tax deferred. They're not tax free, right? So, all right. Here's the fun one, Dan.
Okay.
Steve, I got a business proposition for you guys. Ready for this? I didn't prep you for this, but are you ready?
Dad, you got the. I'll let you.
All right, Steve. I got a business proposition for you. All right, you ready? Here it is. Okay, the business is going to be completely funded by you. Okay, I'm not going to put anything in it. I'm going to have you put all your money in it, and there's going to be some risk, some pretty significant risk, and you're going to be the one taking all of the risk. Okay. So we're going to do this for 20, 30, 40 years. And when it comes time for you to retire, here's my business proposition for you. You fund it, you take the risk. And when you retire, Steve, I'm going to tell you how much you owe me. What do you think? You want to go in business?
That's not that the IRS today.
Well, you nailed it, right?
Well,
that is exactly.
In my former life, I do tax preparation in the tax season, so I'm very familiar with the IRS and how they suck into these IRAs.
Yes, but honestly, it's kind of a funny, it's a little bit meant to be a little bit tongue in cheek, but what most people don't realize that is exactly how a 401k works.
That's kind of different.
The business proposition I just mentioned is called a 401k, by the way.
So is there a counter offer?
Well, there's one called a Roth.
Sure.
You know what you're paying now, and it's tax free. But if it's an individual IRA, you put in money now tax free, and you don't know what their cut's going to be. Same with California. We
Absolutely.
the high state tax area here, very high.
Oh, absolutely, right. So a Roth IRA certainly has those similar tax advantages, right? Also has that similar tax favored status. So
But you pay the tax. You know what you're paying the tax. You don't know what your gain's going to be.
Sure.
But you know there's tax free on the outside, on the back end.
Yeah. Another way to put it is like, okay, picture a farmer, let's say a corn farmer, right? Plans on planting a 10-acre field, and he's got this huge bag of corn sitting there, right, in his warehouse. It's just one big, huge bag of corn, right? So he has the option, he has the choice of paying taxes right now on that bag that can fit in the back of a pickup truck, right?
Yeah.
Now, or pay taxes on the entire 10-acre harvest, which is truckloads full of corn, right? So if you step back for just a second and you have the option to pay a little bit of taxes now or a whole lot of taxes later, it doesn't take too much to connect those dots at which one's better.
Oh, absolutely. So then the opposite of your proposed business would be the other. So it would be the indexed universal life then, correct?
Absolutely. So, by comparison, and here's another interesting feature, right? So what's the L stand for in IUL, right? Life, which is implying life insurance, of course, right? So a little bit of a trick question. If you put $100 into a traditional IRA and you die the next day, Dan, this one's for you. Any guess on how much your family might get? You put $100 into an IRA and you die the next day.
$100.
No, they get about 70, right? $75 because they got to pay taxes on that, right? So with this being a life insurance policy from day one, let's just say that $100 that you put in there equals $100,000 policy, life insurance policy, and you die the next day, your family would literally get $100,000 tax-free. This protects you and your family if the unexpected happens, right? Like we all expect to make it to retirement and live a long, happy life. But what about the unexpected? This also protects against that instance.
That is interesting on that. So from the boomer perspective, Dad, what's your take on the Indexed Universal Life, or the IUL, compared to traditional life insurance?
It's a good question, because I had 7 kids, of which he's kind of in the middle of the pack. And I had a decent job as a programmer and director of software for a company, but didn't break the bank, just made decent money. And I basically had a nice company, a small company, but they had a 401k match. There were no Roths in those days. I wish there were, but there weren't. And my solution was, I said, okay, first of all, I had life insurance with the company, and it was just a term life. They paid twice your salary upon death. But the problem is, if you left the company, you have to go hustle and get something yourself. Turns out that would have been enough. I never had that happen. But I said, okay, what is the least expensive way I can insure my family? And so what happened was, I said, okay, I could get a renewable term, and it was a level term for like 15 years was the first one. See, I didn't do this when I had 7 kids. I started when I had like 2 kids. So I did like a $100,000 policy, which then was enough money to deal. And if I were to die, that my wife could use this, not have to work, and get them through high school at least. College, they'd be on their own, because I didn't want to break the bank that way. So I got that. I think in the day, if you bought just term 1 year and then you re-up the next year, it was a lot cheaper. But if you got sick, which is what would happen, you don't necessarily die the same year, they wouldn't renew it. So you get a renewable thing for like 15 years. So I did that. I think it was $450 a year. And then when I had 5 kids, I kept that policy, had another one for like 15 years, another level term. So I kind of staggered them. And then the investment vehicle was the 401k. And then ultimately, people pro and con on this, but the house was kind of some people say you can't count this as an investment, but it typically goes up and you can refinance, which I tried not to do, at least to draw money out. So bare bones insurance that I can do until the kids are of age where they can handle themselves, and then put the rest of the money in a 401k. The only thing in those days, if I was a high earner, I think an index, what I believe on IUL might have been a good thing. I think high earners have to shelter money in addition, but I wasn't at the level where I had to worry about that. Long answer, but that's what I did in the day.
Nice. So I guess we'll field this for both of you, because, obviously, maybe income level. Does income level, from your perspective, Val, does income level determine, like, have a demarc of the higher income levels, that's where IULs fit best? Or is it debt protection, retirement, legacy planning? Where do you see it fitting best as far as a use case?
Well, I mean, I'm a firm believer that certainly better to do something than nothing, right? If you can afford to put $10 a month into a savings account, put $10 a month into a savings account. That's far better than the alternative of not, right? So this can be utilized for your average American, making $30,000, $40,000, $50,000 a year, more or less, right? But if we think about it as a long-term savings vehicle, if we put twice as much in there down the road, we're going to have twice as much money, right? But there is no minimum. Like, we can write these, a whole nother topic for another time would be getting kids started with these things at $20, $30 a month, right? But more realistically, as you're starting out, like a good rule of thumb is, really good rule of thumb is about $100 per month per decade of age, right? So if you're $300 a month, but not everybody can do that, right? So again, something is far better than nothing. The plans can start from $25, $50 a month. But again, the more you put in there, the more you're going to have down the road. But starting somewhere, as far as retirement, like planning, legacy planning, it really checks both of those boxes because it is a life insurance policy. And if something did happen, the death benefit is always going to be greater than, potentially far, far greater than the dollars that you've put in there.
That is interesting on it. So what I'm hearing mainly is probably more on the retirement legacy side, and then like you should really focus on getting out of debt predominantly first versus retirement and legacy planning, or you kind of try to tackle both at the same time?
Well, I mean, that could be an overwhelming, it's going to be typically what I have when I speak with people, how many people have debt? Well, the vast majority, right? 90 plus 95%, whatever the number is, right? But that's certainly an issue, and we have solutions for that as well. So what we say is if you have debt, if you have some retirement, no retirement, we have solutions, right, for that, because we can either help you create a retirement account, and not necessarily exclusive from you protecting an existing retirement account in the form of, let's say, a 401k rollover or something of the sort, right? Where we can get the funds secure in a secure account that's growing without any market risk, but where you could still get market-like returns. So I don't think there's any one really right answer for that as far as finding that balance between, paying off debt, saving towards retirement. Both are certainly important.
That definitely sheds some light.
Well, when you threw the D word in there for debt,
we're gonna get to debt next, because that did raise some questions. So from your perspective, Dad, the Index Universal Life IUL, what's the best use case from your perspective? Debt protection, retirement, legacy. Pretty much, I'm just asking you the same question. What is your take?
Well, again, I try to keep things simple. I understand term life. If you die young, you win. You don't want to die young, so you just basically want to win.
I don't want to win that game.
Yeah, you don't want to win it, but you got to play the game and put money into it. But in terms of debt, when you add debt to the equation, I mean, credit card debt can be 25% a year. And if I had that plus wanted to get the term, the stuff, I'd say bare bones life that you need for the family, pay off the debt, then look at retirement. 401k, IUL, whatever it's going to be. I don't agree with Dave Ramsey on a lot of things, but he's a hawk on debt, and I agree with him there, especially student debt. I think it's foolish to go $100,000 in debt with a gender studies degree from Stanford. But then credit card debt would be almost as bad. And the good debt, well, if you want to call any of that good, I don't mind having a mortgage, because you have to either rent or that. And especially in California, if you get a fixed rate loan, your expenses for the shelter are fixed, and property tax here only goes 2% a year, at least currently. They're trying to change that, but they never have in the last 60 years. So that to me is good debt. But bad debt, get rid of that as soon as you can, even at the expense of going for retirement stuff. That's just my simple rule.
Awesome. Hey, Val, do you agree with the good debt and the bad debt?
Oh, absolutely, right. It's like most people, and one of the common misconceptions is that their mortgage or their home is their greatest asset, right? And for most people, it's their greatest liability, right? So, as far as having that as in terms of relating it to debt, I would say so, absolutely, right? Because especially in the early years, the first half of our mortgage, the majority of our payment is going towards interest, which is tax deductible, which is of course a good thing.
And then so debt came up, mortgage came up. So let's segue into mortgage and debt. So as you said, greatest asset, greatest liability. A lot of homeowners probably worry about, paying off the mortgage faster, so that, they want to get the great American dream getting to zero on that, and they want to get out of debt faster, mortgage and everything. What kind of solutions, or how do you help families, or do you help families who want to get out of debt faster?
Sure. Well, there are certainly programs there. So now we're shifting gears a little bit from retirement to debt, and from something called an index universal life to a different type of life policy, to where you can fund this policy, have access to the majority of the money that you're putting in there. And I'm not sure how much detail you want me to get into, but where you can actually utilize that money twice, right? So if you have money in a bank account, you spend $1, that dollar completely loses its buying power. It's no longer in your possession. That dollar is gone to work for you one time. With these types of solutions that we do provide, what if that dollar can work for you twice, right? Has to do with the inner workings of something called a participating whole life policy. Without getting into the specific details of how that works, it allows you to put money into a life insurance policy, access the majority of that money almost immediately, and have that money go right back to work for you. All the while, it still has the potential to earn some interest within the policy. So there's some inner workings as far as how the watch works. Most people want to know what time it is, and what the clock is going to tell you at the end of a period of time, based on a mathematical equation, is how long it's going to take you to get out of debt. And we can calculate interest, all of those things. We can look at an amortization schedule of saying, hey, doing it this way is going to take this number of years and months. Doing it this way takes this number of years and months, utilizing potentially the exact same dollars that you're already putting into your mortgage or other debt.
Interesting. So to be clearer on that, so let's just use that. I pay $100 a month towards this policy, of which the benefit amount, basically, if I, as my dad put it, if I win and die, gets paid out $100,000. So if I were to deposit the $100 in a checking account and spend it, the $100 goes to work. With this, I take that $100. Do I have like $100,000 to like borrow against, or is it like, how does that work if that? So I pay what I'm paying monthly versus the face amount. How does that exactly work at a high level?
Yeah, no, that's a great question. And another common misconception, right? It happens all the time where I'm asked that question, right? So you're putting $100 in, and the misconception is that you have access to $100,000. You don't. You simply don't, right? The short answer is you don't.
Yeah.
So you do if you die.
That only covers one thing, and you don't see any benefit from that, quite frankly. Family gets a huge benefit from that, but you don't, right? But no, putting $100 into it, you have access of the majority of the money that you put into the policy. And sometimes these policies are funded with what's called a lump sum, right? So we have the ability to structure the policy as such, where you have some money sitting in a bank, right, that you want to be more efficient. You're basically funding, if you think of it as funding a bank for yourself, right? So the concept, tons of information out there, but I don't know if you want me to say it or not, but infinite banking concept, right? That's the concept behind it, to where you're effectively becoming your own bank. Here's the catch, right? They say, what's the catch, right? To have funds, you have to fund it. The money's coming from somewhere. It's not like putting $100 in and you have access to $100,000.
Thanks. Get it for,
They
they have the money for free and just lend it out. We have to actually fund it ourselves, being individuals.
Correct. Yeah.
So that is the infinite banking that puts a nice sexy spin. That's an awesome concept.
Yes.
Of that, because I do find it interesting. Now, when one common misconception, at least John, my good friend John, who also works for agent with Symmetry Financial, not as he's a licensed insurance agent for mortgage protection, but when it comes to the payoff, it's not, you have to be paying more than what your payments are in order for a program like that to work, correct?
That is absolutely correct. And I'm glad you brought that up, right? So the catch line, the catchphrase is, Dan, if I could show you how to get out of debt in 10 years or less, including your mortgage, without paying any more money out of pocket than you're paying right now, would you be interested in finding out more? 99 people are going to raise their hand yes, right? That's predicated on one really, really important detail, okay? That you have an active plan to pay that mortgage off more quickly, your car off more quickly, your credit cards off more quickly, right? Because the debt doesn't go away, right? So let's say your car payment is $500 a month, hopefully not, right? But you're paying $700 a month. Your mortgage is $15 and you're paying your mortgage every 2 weeks instead of once a month, right? So, half of your mortgage every 2 weeks, which gets you an extra payment every year. So those are extra funds. So what we're talking about is maintaining that debt, those minimum payments, but redirecting those, what we call inefficient dollars, like on the car payment, that extra $200 a month. On that credit card, instead of paying $50 a month, you're paying $100. So there's an extra $50 there, right? Redirecting those funds that are already coming out of your account and currently going directly to the debt, funneling those same dollars through the policy. So that question where 99% of people are going to raise their hand saying, I'm interested, not everybody, it's not a fit for everybody because not everybody's currently doing that. So that's when we do these, what are called discovery calls, to see if there are solutions that we might be able to offer that can help. They can certainly pay more money out of pocket and pay it down more quickly. But what's amazing is the calculator, the program that we have, the software that we have, I should say, does all of the math for us. So instead of, in the traditional sense, you'll be out of debt in 23 years and 2 months, maybe it looks like 12 years and 1 month, and maybe you've saved $212,000 in forecasted interest.
Or what's the typical reaction to, you do the math, they're paying extra, and you're like, by the way, I can get you from 23 years to like 7 years. Is that what you're referring to earlier? Like, it's
Yes.
too good to be true? Or like, what's the typical reaction to that?
Yeah, a little bit of too good to be true. The great thing is the math supports it, right? These policies have guarantees, right? We know what their current interest rate is on their credit card, their car, and their home. We know what the stated interest rate is within the policy. These are just all guarantees, right? So we can forecast with mathematical precision what that debt-free date is. But I'll tell you, there's another catch, Dan, and here's the reality of it. Like, for the plan to work, they gotta stick to the plan.
Whoa, Dad.
Wait a second.
Wait, you have to stick to a plan in order for it to work? What's going on?
Sorry, you knew there had to be a catch, right?
Got it. And I'm curious that from a boomer's point of view, your typical approach, because you alluded to it earlier, like these type of things didn't exist back in your day when you had to walk uphill in the snow both ways, barefoot. But how do you typically approach mortgage and protection? Like, what do you think of all these modern advanced market solutions that we've been talking about?
I'm old school. I want to fund if I die. I don't know if the mortgage protection handles if he gets sick. I don't know. I don't know the weeds of that plan. But assuming it's just to die, I'll get that covered. In that case, in my case, I thought that the life insurance, I looked at whole life. Maybe they have IULs, but they had whole life, and it was pretty rigid. You put this money, you put $2,000 a month in, and then cash value would grow up. But if you had to take it out, either you're borrowing your own money at interest, you have to pay the insurance company, or you reduce your benefit. And it was too rigid. That's why I like the term. And then eventually, if I have enough money, I won't need insurance. So just build the money as quick as you can inside IRAs, outside of, if you have any extra, and save that $300 or $400 a month into that. That's how I handled it. And the other thing was, when I put the 7 kids and my wife too, through private school, through high school. So in summer, I knew what the next tuition is going to be, and I'd tinker with my 401k withdrawal. And sometimes it was as much as 10%. I couldn't go, I never did 15. I had too many kids to do that. But sometimes I dropped it to like 1 or 2% because I didn't want to go in debt, and this is what I could do to stay solvent. So I didn't like the rigidity of the insurance because I could dial the numbers myself. Now I'm an engineer, so I could fiddle with, grant a lot of people don't know how to do that, or have no desire to do that, they're not interested, but I had the desire, and that's how I did it.
All right, so, but kind of what I'm understanding, by term, invest the difference, and Val, more buy this and accelerates retirement.
Yeah.
So kind of like am I understanding
Well, here's the
different
thing.
points?
Buy the insurance and it invest inside the policy. Mine is you buy minimal insurance, and I handle the investment. To his point, a lot of people don't do it. I did it. I hated going down to 1% on the thing, but then I try to pop it up. Some people, I'm never going to invest in it again. So I get the fact a lot of people aren't disciplined. Maybe even over, I don't know what, maybe over half the people. But for me, it worked. I'm not sure it worked for you. That's why I'm glad that
I'm still working on that. You know how you said it was very intelligent for student loans. I'm still chipping away at the good old student loans, which that's a whole different story, Val. I was in Denver at the conference talking to some random people. They're like, oh, I'm like they're talking about like not even paying their student loan, just letting it go. I'm like, not going to pay your debts, but it's like, then if that's your view on student loans, I fear for you when it comes time to retire.
Well,
that one's not going away.
Yeah.
And the
that
problem
particular
is
one's not going away.
you have an 18-year-old making a $200,000 decision potentially. That's what can possibly go wrong.
Exactly. Exactly. Now, switching gears on it. Now, shifting over to retirement. For both of you, a scale of 1 to 5. We'll start with Val first.
Okay.
How concerned should families really be about market loss? Like, let's say the next 10, 15 years. 5 being really concerned, 1 being not concerned at all. How concerned should they be at market losses eating into their retirement?
How concerned they should be.
How concerned they should be.
Off the chart. It should be a 5, right? So there's something called market timing. So if we look at the market, we know over time it's going to grow, but we know something for sure that is 100% guaranteed is the market's going to go up and go down. So here's a terrifying thought that happened to millions of Americans that actually happened, right? So let's say you're getting ready to retire. You've worked 40 plus years. You're turning 65 and the year is 2007. And you have worked really diligently and saved up $1 million in your retirement account. And we all know what happened then, right? The mortgage crisis, the housing bubble, whatever you want to call it, right? Where the market actually went down 38.4%, and that $1 million account is no longer $1 million account. It's $620,000 or whatever that is. The next 10 years, it's commonly referred to as a lost decade. So it took about 10 years to break even. And here's the thing, Dan. You're 65, you have a choice. You could do one of two things. You could still retire and adjust your retirement down by 38%. Your standard of living, or you could keep working. You're forced with a really difficult decision. If you decide to retire and start touching that money, you will never get back up to the $1 million. Never. You don't have a chance at it, right? So market timing is something that's very, very real. We've been generally speaking, the market's been very favorable for a very long time, which is telling you what, historically, it's due for a correction. And that should scare people, right? Because maybe you have time to ride out, maybe you don't, right? But if you're retiring in the next 10, 15 years, you might consider putting into something that has a guaranteed floor of, even if it's 0%, imagine now it's 2008 and your $1 million account did not gain anything, but it also didn't lose anything. That's called ROI. But not in the way that most people think, right? What does ROI stand for, Dan? Here's a quiz. I know you know the answer.
Let me see here. Return on investment, I believe. Did I pass?
Correct. But in 2008, you know what people were looking for?
What?
Return of investment. How many people would have been happy to get 0% in 2008? The answer is 100% of those people that lost that. So market timing is a very, very real thing that people should be concerned about, because there are investment vehicles where you can get market-like returns with no risk.
So 10 to 15 years, if you're within 10 to 15 years of retirement, then it's a 5. What about if you're not retiring for 15 plus years, then it's maybe still a 5 or a 3?
You could roll the dice if you want, but what if there were vehicles? Here's the part where the disbelief sort of sets in, right? What if there were vehicles where you could get market-like returns with 0 risk? And what if these vehicles historically have outperformed the market? So not just market-like returns, but greater than market-like returns. And again, we have 20/20 hindsight, right? We know with mathematical precision exactly what the market's done and exactly what these products have done. And what if I was to tell you if we were to take any 10-year rolling period of time, right? So from 2000 to 2010, from 2001 to 2011, right? Any 10-year rolling period of time, that 100% of the time, these products have outperformed the market. It may not be that primary of a concern, but there's a point where it starts to just make sense, right? We don't know what the future holds, but if it's anything like the past, and here's the thing, all of these statistics include years like 2008, years like 2020, years like 2022, where we see these major market corrections, and all of that still holds true.
Well, you missed the big one, not just 2008. I call it the aughts. From 2000 to 2009, 2000, 2001, 2002 was the dot-com crisis.
Oh, early ones, yeah. Early, even further back.
Then it tried to recoup, and then 2008 was the big one. And that 10-year period was probably the worst since the Great Depression, those 10 years. Since 2010, though, it's been pretty good. Now, I'm not saying it's going to keep being good, but I would challenge you. The products I looked at in insurance, you don't get market-like, they cap off. If the market's going to gain 15%, they cap it at like 6 or 8. You don't get the whole market gain. Granted, they do cut off. Sometimes you're guaranteed a 1% gain. And if the market loses 40%, you're guaranteed to lose 0 or maybe 1% gain, which is nice.
Sure.
But if I was Dan's age, I'd rather go for the market if I do little by little than something where it caps my gain, because most of the gains S&P has are well more than those 6 or 8%. Depends on the plan, obviously, but the ones I've seen are.
And there are plans that have caps of 10 to 12%, and there's other ways to calculate interest based on an index, without getting into the weeds too much. But our participation rates and spreads, there are products that capitalize on those. Like we have some IULs that cap out at 12%. And if we look at those, it's going to outperform the market, even with those major spikes and corrections. But you're correct. If you're looking at a product that has a low cap, you may be better off in the long run. But yeah, it depends. So make sure you're working with someone that has access to, those types of products.
Yeah. Which well, obviously there's a lot of different products at your disposal, Val, which is awesome. Dad, from your perspective, okay, what tools, let's talk to like a Choney boy or Tim. What tools do that exist today that would give people both growth and protection, from your perspective?
Wow, I wrote a whole chapter on that. This gets off because I'm a strange bird. I don't adhere to any of the philosophies of Portland. It's going to sound, I don't know if I do it today, but in my day it worked great. If you took between 30 and 40% gold and 60% market, and you invest in PDEs, price to earnings ratios under 15, that mix in 2008 didn't drop as much. Gold dropped, but it came back pretty quicker than the market did. And it smooths your losses, and your gains would be good. So I think what I try to teach people, don't buy an index, buy companies. And you have to look every day. Do you buy solid companies that may be growing 5% a year? They're giving a 3 or 4% dividend. The trajectory is up. They've grown maybe company annual growth rate of maybe 8% for the last 20 years. Good marketing thing. I want to teach people to invest in those because at Dan's age and forward, that's where the money is going to be, I think. And by the way, I'm not saying exclusively. It's like you can mix and match. I don't say to buy 100% life insurance. You can augment, do a certain percent life insurance, certain percent investment. You don't need to go all in on one investment. And I wouldn't advise that anyway.
I would 100% agree with you, Steve. Yep.
Awesome. So, and shifting over here, so we talked a lot of theory. Val, could you, without disclosing any confidential information, but like a real world example where you work with someone used these solutions and how it impacted their life, without giving any personal details, but a real world example so people can sink their teeth into it.
Absolutely. And
oh yeah, you can use Jane and Pete, as my dad says.
Okay. Well, generally speaking, like it depends on which solution we're talking about, right? But if we, I primarily focus on index universal life and retirement protection, right? But if we're talking about, for example, index universal life, a common illustration is that I'm running for, let's say, a 50-year-old. Generally speaking, we want to be able to fund these things for 10 to 15 years, right? So there's that number again, right? The longer, the better. But, showing someone where they can put in, let's say, a modest, or I don't want to say modest, but, $300-400 a month into something where if we can forecast what that's looking like while they're here, right? Because we're talking about the living benefit side of things. If they die, it's going to pay out way more, sometimes 10x or more than what they put into it, right? That's a separate thing. But while they're still here, if we forecast them living out to age 95, they could see real returns in their lifetime of, 10x from return. And one of the key components to all of that is the fact that the money that they're getting is actually it's accessible tax-free in the form of loans from their policy. So showing them in real time on an illustration that are always conservative, at least the ones that I run, right? Where they're funding it for a period of time. They stop funding it. Let's say they're funding it from age 55 to 60, for example, and then the policy is then paying them out again, for example, from age 65 to 95, and showing in real time how that can benefit them and what the actual return is in that case, right? Making those assumptions that they're going to live to 95, but that's all we can do.
Oh, that's awesome.
Yeah.
And Dad, so from your perspective, what is the litmus test to decide? You said diversification, but decide considering insurance versus traditional investment or the mix. What is the litmus test to help what they should do? Like what should they look at?
If they can do it themselves and understand, great. Otherwise, you want to get a financial guy, either a guy like him or a financial planner, to help with that, because a lot of people haven't got the wherewithal to do it. And then so I do, and I'm trying to teach that, but I guarantee you a lot of people in our audience, I don't want to go through that. I don't want to do it. I could do it. I don't want to.
Hence why we started started this audit. And Val, thank you so much. I know we went double the amount of time. I know you're a busy guy and appreciate it. And this is the exact type of perspective we want. And I'll put it, how would someone wants to learn more or get in touch with you that has questions, what's the best way for them to get in touch with you? Should I put a link in this, like a calendar link, or what would be the best way for them to get in touch with you?
Yes, absolutely. I can provide a link to, get on my calendar. What we do is set up what's called a 10-minute discovery call. We refer to that to see if there's even any ways that we can help, right? So the focus on that initial call is just understanding, like without getting into the nitty-gritty of things, right? But understanding your general overarching financial picture. And then from there, working towards any potential solutions to where we might be able to help you out. So I can certainly provide you a link to do exactly that.
Perfect. And then do you have a website?
Yes, you can go to, I'll have to figure that one out.
Oh yeah, either way, you do have a website. I'll put it.
You have to edit that part.
I'll put it on the screen.
There you go. Yes, I'll go ahead and put my website on the screen there, Dan. That'd be great.
How about a phone number?
And we'll put a phone number as well.
Yeah, I have to say it.
Oh, say your phone number, Val, and if you want people to have it.
Absolutely. And text preferred because I'm on the phone all day, please. It is 951-440-4046.
Awesome. Well, thanks for stopping by. Any words in closing, Dan?
Thanks for the time and respecting an old guy's point of view.
I absolutely respect it.
Awesome.